so much, Aditya. And I'm personally very excited to be here. And thank you for the invite from IAIF and Equalify and to the Investment Trust of India. Um, I'm personally excited about this topic because we are seeing an unprecedented growth in terms of investments, the check sizes, etc. We have 81 unicorns, about seven the last week, this year itself, 5 weeks, and seven of them. In terms of surge of investments, both there's a surge in terms of number of investments as well as very, very large check sizes coming in. Sometimes, back in the days, it used to be a 4 to 5 million as a Series A to now even some of them, like 20 million checks, are also being called as pre-Series A. So that's an interesting change. And over the 2 decades, there have been many changes, right? And this is what we are going to talk about the next 45 minutes to an hour, where we are talking about the changes in the kind of structures that we've used, the kind of pooling vehicles, online, etc. The investor class itself, there are a number of different investor classes taking a very active interest in early stage investments and the growth stage investments. And I think technology is playing a very large role in this kind of a disruption, not to mention the building block of having internet and data access throughout the country, including tier two, tier three cities, where we are finding new investors joining the gang. And we have like Aditya mentioned, we have a great panel here. They have deep experience and expertise. They have ridden over many of these changes over the last 2 decades. And and you will see them up close and personal in terms of the changes that they have witnessed. And some of them are change makers themselves, and that's the exciting part of it, right? They can tell you upfront from their personal experiences of what is it that they saw as a change, and they have been at that vantage point to actually point out those kind of changes. So here is my really, really interesting panel. And while Aditya did introduce all of us, but I do want to take a moment to kind of make some introductions, because they have been my great friends, and I'm making great new friend with Mohit, whom I'm meeting for the first time. And I have seen Manish Singhal go from Let's Venture to Sarathi days to those of you who do not know him yet, he's an amazing executive coach as well, a CEO coach as well. And it is so calming when he kind of makes points that you think, damn, I didn't think about it. So extremely interesting. And if you do want some kind of a coaching, you should hit up with Manish in that, from that sense, apart from, of course, asking for his check. Ravi is a very dear friend in terms of I have seen him an entrepreneur investor, and I think he's both in equal measures. So the kind of operational intelligence he brings to some of the startup companies that he works with is incredible, and I think that's why the startup portfolio companies do really love you, Ravi. And Sandeep, I think there's no introduction needed. And I think Sandeep's experience is so deep that I think I wouldn't make justice in explaining that to you. So that's my panel. I would like to kind of start off with some of the changes that we are seeing, right? If we take a 15 to 20-year landscape, I'll go around each one of you. What are the changes that you have seen? There's an uptick of investments like we spoke about. Why do you think there is this change? And what are those building blocks or the ground level changes that you're seeing? If I can go from Sandeep to Manish to Mohit and Ravi next.
Thanks, Shada. Thanks for having me on the panel. When I started my journey looking at venture capital in India, this was way back in 97, 98. And at that time, there weren't that many entrepreneurs that were there to invest behind. The capital that was available to these entrepreneurs either typically came from their own families or, their communities. So the Marwaris would fund other Marwaris, the Gujaratis would fund Gujaratis, and that was the source of capital, particularly risk capital, that one saw. We as a external observer, I could clearly see a big gap in that market, which sort of led us to start eVentures. And then subsequently, I set up Nexus in 2006 because there was a big shift that one saw towards product and IP-led sort of opportunities. So the late 90s, early 2000s was still very much a labor arbitrage play. By 2006, it had sort of moved towards more IP-led opportunities and domestic consumption. The 2003 to 2005 period in India was sort of a golden period where you saw tremendous growth in the public markets. And that sort of led us to say, okay, domestic consumption is going to pick up. So those were the two themes that led us to set up Nexus. And then, after doing this for 15 years, I'm now seeing a very interesting shift towards more and more specialization in fund formation and investment. So today, when you're looking as an entrepreneur, we are looking at investors. You're actually going to individual investors and saying, okay, this person is a fintech investor. This person is a deep tech investor. This person is an agri-tech investor. This person is a climate and sustainability. So I think that's where there's a big shift that's happened, and it's been driven by both an increasing amount of capital that's coming in, as you mentioned, but also increasing amount of sophistication on part of the entrepreneurs. So the entrepreneurs are also choosing capital sources more wisely. And just from my journey, after doing technology investing for the last 20 years, I decided that there was a big sort of gap in climate and sustainability investing. So that's the next thing that I'm doing. Just to sort of.
And Sandeep, do you think that this kind of specialization is across stages, or do you think the early stage investors are still sector agnostic?
So you have people on the panel who are very, very specialized and are doing early stage. So I think there is specialization that's emerging at all stages. And so even when I look at climate and sustainability right now, today Everstone has Eversource as a platform that's doing climate, and you have TPG doing TPG Rise, you have KKR doing KKR Impact. So there is sort of specialization that's happening at all levels. In some ways, Ribbit is coming to India, positioning itself as a fintech investor. Owl is looking at India and positioning itself as an edtech investor, because that's what they are in global markets, right? So the specialization trend has obviously been happening in the US for a long time, because once you get to 2,000, 3,000 funds in the VC private equity space, you have to specialize. You just can't say, okay, I'm going to give you money. So both as GPs, as people who are investors in companies, as those sectors emerge as large sectors, you tend to end up focusing on a particular sector and say, I just understand fintech so well as a partner that all I will do is fintech investments, and all my portfolio companies are going to give me the next set of investors, the next set of investments I'll do. So that becomes a virtuous loop, right? So India, I would say till probably early 2010s, right? 10, 12, even 14 was still a very sort of generic investor market. As a fund, you couldn't say, I'm going to do a very specialized thesis. People tried that a little bit with clean tech in the 2010-11 period, but that was a very short phase. It just sort of died. Most of the funds that are there from that vintage are all general funds. So us, Sequoia, Excel, Elevation, they're all sort of.
Yeah. And Manish again is so focused on deep tech himself. So here we have Manish with a specialization, and Manish also is kind of a change maker because of his previous experience with Let's Venture as well, which kind of started off some changes that we saw in the VC industry, or how startups started pooling money. What are your observations, Manish?
Yep. Thank you for having me on the panel. I think Sandeep has really laid out this change in the Indian venture landscape very well, right? So in my mind, I wanted to say something, but just to extend that point, right? Change has happened in what the market has. So earlier, it was all market share led thesis. Can I find another Ola? Can I find another Paytm? Can I find companies which through internet can take market share, right? And that has changed over a period of time to product and IP led ventures being created. So as we go deeper into this, there are two things which are driving the need for specialization. And I come with a biased viewpoint because we are a specialized fund ourselves. One is that more and more ventures are getting created in that space with sophisticated depth in those spaces, right? So if you talk about artificial intelligence, when I started the fund in 2016, hardly any AI companies around. And today, hardly any companies which are not using AI or not thinking about using AI. So a massive change within 5-6 years, right? So now the companies have become more sophisticated. The entrepreneurs have more sophisticated. There is a critical mass of those kind of companies. So there is essentially demand over there. Second thing that has, so of course, as an investor, you have to keep pace with it. You need to be able to understand that depth and then make decisions, right? So that drives specialization on one end. The other end is just the pool of money available. I think today we live in a completely global market. That's my belief. So if I'm doing well as an entrepreneur, I can get money from anywhere in the world. It is not located. Sandeep talked about community-based financing in the beginning, right? And which is, of course, was there. But even 2 years back, we were somewhat geographically limited, right? So, but now with the Zoom world, we all live in a Zoom land. There is no countries anymore. And therefore, if you are doing good, then you will be able to attract money from anywhere in the planet. And if that is so, then as an investor, how do you stand out? Right? You can't be one more person with the money because money is available. If you're doing something worthwhile, money is available. There is no dearth of money.
So your competition increased, Manish?
Yes, our competition has increased, and I'm glad about that, by the way. But the point that it is there is that just the sophistication of what kind of ideas India is creating, number one. Number two is access of money for those ideas will need every venture capital firm to think about how do we really up our game to stay competitive in the game, right? And that to me is a big change which is happening, and which is the need for a specialization, and it is a natural evolution of the process.
More money, good for us.
Yeah.
Mohit, what are you saying? What are you seeing as a change?
Sharda, this panel is just so intimidating for me, right? Because Sandeep mentioned that, he started looking at venture investing in 97. I was 9 years old at that time. So anything that I say, it doesn't have even like one by n the number of experience that these guys have. I can only speak from, what I have seen over the last decade. And I have a view which is slightly differing from what Manish and Sandeep have said. Of course, they've had a lot more experience and have built much larger practices. We are a smaller fund. We are a $25 million fund. But I started, my angel career started with, becoming a quasi logistics expert. So my first investment was Ecom Express, which turned out to be one of the second largest e-commerce dedicated firms here for logistics. And then I did Grab, which we sold to Reliance in the hyperlocal space. And people started sort of looking at me as a specialist for logistics. So I saw Loginext and I saw a lot of transactions in that same space. What I realized is that because I had built 2-3 large logistics businesses, I had biases around what I was looking. I felt that I'm too close to this industry, and my own individual biases made me not make investments. Like Loginext, Dhruvil's first POC was done by Ecom Express because it was created by me. It should have been an investment I should have caught on day zero when he had not even started raising money. But because I was so close to the sector, I felt that, no, this will not work, or scaling this is difficult. And which is where I felt that, at least, since we are in the early stage space, I think the agnostic strategy has worked out better for us because it gives us the ability to play risk and, diversify things. Also, if you look at the last 10 odd years, right, we have been in a structural bull cycle, barring maybe 1 or 2 years, which have sort of fallen off. My sense is, at least if you're a consumer facing fund, if you look at a 3 or a 4 year bear cycle that comes in, you know, quote unquote, shit can hit the roof, right? If all you did was make investments in the consumer space or fintech. I mean, everyone's so bullish on fintech, but to be honest, today I think Amazon will be a larger fintech player than anybody else would be in the BNPL space. So I think, you know, everyone has their own strategy sort of developed. At this moment, at least in the early stage side, we are thoroughly enjoying being agnostic because we're doing drones, we're doing med tech, we are doing EVs, we're doing education tech, we're doing a plethora of things. And I've sort of created specialists in my team who are looking at sector focus. But on the top of it, the umbrella remains agnostic. And that's, at least for me, that's in India how the agnostic approach should work, given multiple cycles that will go through.
Interesting. There are enough and more, like Sequoia has become sector agnostic, and you kind of see their investments in literally every kind of sector that we can think of. Ravi, you have been an entrepreneur and a VC. You have sort of wanted to you have raised money for your earlier ventures, and you are raising money for the fund as well. What do you think, from both sides of the table, what do you think has been the kind of changes that India is witnessing in this sector?
Yeah, so very, very interesting, right? So I was listening very closely to all of them, Sandeep, Manish, Mohit, they're all talking about the funding side. So my first exposure to raising money was way back in 94 when I started my first venture. 94, we started that. It was a ERP consulting company, zero funding availability, nothing at all, right? Absolutely zero. This was way before that. 96, we sold it to Oracle, but we had a lot of stock options, which meant nothing in those days. So I think the fundamental difference, if you go back and look at what happened, and incidentally, I sold that, and that's when, post that is when I got involved with the startup ecosystem, right? We started an incubator, which later on, it was called Erasmic. Later on, it went on to become Axel. So Prashant, Subrata, and I started that piece. All we did was bring in companies, incubate them, because we knew that they needed the help to get on. So, from a entrepreneur perspective, I think a couple of things have changed. First, in those early days, there was really no availability of funding. So you had to go to the friends and family, or you had to go to some other place where as Sandeep said, you had to go look for people that would come in and work through. And the only way we had a workaround was, although we may have had great ideas. So for example, I too was incubated at the same time that I was doing a supply chain company, right? All of us had no choice but to take the services route to fund our cash flows, right? In the early days, if you go back and look at how that has grown, I would say that there are three cycles in that, right? The early cycle was the services-led IT startups that came in. What then happened was these guys became, or some of us came out and said, hey, all it needed was a small amount of money. And if we could go in and initiate this, why would this not work, right? So if you look at the incubations, early 2003, I've done a few incubations at that time. I did some all the way to 2010. You'll see that there is a whole cycle happening there where small checks were being returned. And that is when the angels came in. And that is when some of the BPO side guys moved on and said, I'm going to raise funds. So the earliest people who raised funds in the big names are the Quattros of the world, right? They were not the product companies in some ways, right? So Mu Sigma raised fund there. Flipkart was one of an exception that was following the Amazon model. It was the Quattros or the Mu Sigmas of the world who actually raised the earliest set of funds that came in early. Having said that, I think there are a few other changes. The cycle, I believe, started 2010. Between 2010 and 2015, we had a full cycle turnaround. That's because the founders who had found early exits, or the people who are in senior management in some of these companies, came out and said, I know how to do this. I know the playbook that I can use to apply this. And so if you look at some of the big startups today, or the well-known startups today, if you think about somebody like a Dhruva, you look at Uniform, you look at Orenscape, the tech side I'm talking about, right? People who have built some of these pieces. You will notice that a lot of them were in the 2010 to 2014 or 2015, because these are people who came out having done something else and then said, I don't need to go work for a large company anymore. I have a team. I know how to build this piece. And the falling cost of building together a team and taking it to market reduced, which is when that they could go out with $500,000, $1 million and start up a company. I think that was the fundamental change. And since then, it's gained momentum, right? You now have large people. So if you notice, even today, it's the second time founders who are getting the big checks just on an idea process.
And on a lighter note, Ravi, I think many of us who, I don't want to say we've called ourselves old, but vicariously living in all of these new, interesting ideas as well, right? So, and therefore, I think within this panel, we have more than 100 companies as our angel investments.
So just a point, I think, the one on vertical versus do we do specialization, do we go horizontal? Very interesting, right? I think it's going to go both ways. And I'll tell you why. And I'm happy to have Manish and Sandeep and Mohit tear me down on this, right? That's what a good panel is supposed to be. Take something like a telecom software that used to be built, right? And Manish, I'm sure you can think of it, right? These were telecom verticals where you had a billing software that was built vertically and you would go to market. Today, if you take a look at any software that is getting built, right, it is built on layer by layer. So you have, so you take a fintech, right? You have the KYC layer, that is the bottommost layer, which has UPI, Aadhaar, all the other stuff. So you have an API format where I will go and interface and work through. I have a payment layer, then I have almost like a charge coming in and saying, whatever I will do, I will build a revenue management system on board. So startups are getting built that are layer by layer, not monoliths that I would go and say, I'll build another SAP, I'll build another Oracle. I think those days are gone.
Interesting. I would like to pick on the point that you mentioned, Ravi, where, from no money available at all to now it's become sort of much easier for startups, because there is this platforms like Let's Venture that Manish helped build, where people can go and, small size checks for angels to put in, and lo behold, the startup is actually raising $1 million or $2 million. But there is also a change of, a venture capitalist doing it as a supervised investment versus, some of these other investments are more like, money into the company and perhaps not so supervised. I would like to pick your mind first, Manish, on what are these kind of changes that you're seeing where there is more and more money available and more easier for startups to raise?
Sure. I think last 7-8 years, maybe 9 years, the things that I've got experience with is building Let's Venture, which was a different sort of an experiment where we were trying to crowdsource literally a funding for a startup and therefore enable a lot more people coming into the fold, to raising our first fund, to raising our second fund now. And how things have changed, massive, right? It's amazing. And in my mind, I've rationalized it by having a sort of a journey of someone who wants to, like, let's say, invest in a startup, right? So let's say I have no clue about startup. I read Economic Times, somebody's made 100x on their investment. I get excited. Oh man, why am I putting in mutual fund? I should do something in startup, right? So that's my starting point. So you kind of hustle around, you find either your friend, tag along with a friend, or you find these platforms like AngelList, Let's Venture, you kind of put in some money, get some exposure into the private space and get going with it. And then two kinds of cohorts emerge from that. One is people who liked it, who have now built a thesis in it and are able to do a more better and better investment. So they kind of end up becoming lead syndicates and et cetera, or have their own deal flow, etc. And there are some people who realize this is not my game. I better partner with someone. It is actually, I'm going to lose my money, right? And this translates to a third phase where people who want to still be part of the system, but don't want to just put money blindly, actually end up partnering with VCs quite a bit. So we have lots of LPs in our fund itself where people have done all this, right? And then they do direct investments as well, but they also need a supervised vehicle where they can tag along with us or take our help, especially in specialized field, right? So to me, it is a little bit of an evolution of lots of domestic capital, informed and uninformed, coming through, and various structures catering to it. There will be noise, and it is okay. I think it is fine. People will lose money. They can afford to lose money, people who are coming in this game. So, but the whole cycle of easy availability of money at the beginning, if you have something valuable building, is a very positive system for the Indian ecosystem.
Absolutely, couldn't agree more. And it's not only the startup themselves, right? If you see, you brought about AngelList, so even funds themselves, where AngelList builds like RUV, where they have multiple schemes under a fund, and it becomes so much more easier to actually put in as a fund. One of the positioning that they do take is, a line item, a single line item, instead of having so many people sitting on the cap table. But with that thought process itself, the fact that they are able to raise money for younger startups is very nice. What's your experience, Mohit, when you say these kind of online platforms pooling money, not just startups pooling money, but also the VCs pooling money? And Manish also alluded that, on a Zoom call itself, you can go and do 5 meetings with LPs. So what's your experience been here?
So I think Manish very well summarized this entire journey for a angel investor who turns into an LP eventually. Um, my only problem is the drop off that happens in that journey, right? Because for every 100 so-called evolve angels, the LP conversion rate is probably sub 2%. Uh, so without naming any of these platforms, and there's probably about 15 of them now. I think it's the classic case of it's sort of a gold rush that everyone wants to partner into. Um, Although it's good that there's liquidity that is moving towards early stage side, there is also a little bit of insanity which has sort of stepped in, where literally anyone can. I mean, I kid you not, but we can literally con anyone out of their money. You get 3 people together and say, I value myself at 10 or 15 crores, and you'll be able to raise 2 crores. And there are these platforms which tell you, no questions asked, we will raise you 2 crores, give us the 2% placement fees, give us X percentage of carry on top of it. And we have investors who are ready to do 5 lakh rupees across the length and breadth of the country. I think for all of us who have raised money as with LPs coming to our fund, we realize the fiduciary responsibility of managing others' money. I'm sure all 4 of us here wouldn't have had a great night's sleep without having to worry about the fact that we've not returned back our first fund or second fund. Um, the platforms are not necessarily taking the same onus. For them, it's a very transaction oriented thing, which is, I've been able to do this 2 crore. It's more like an investment banking mandate, right? That I've been able to do the banking deal. I've got my share of the revenue. I don't care if this company does well, or I don't even care if this investor makes money or doesn't. For me, that is where the problem is, right? That leaves a very sour taste. What Paytm has done in this IPO listing is leave a very sour taste in the minds of investors who bought into Paytm. Imagine the same thing happening to you very early on when you just start your venture investing or angel investing journey. It'll draw you away from that asset class. So if that drop off has to be less than 40-50%, we need to strengthen it. We need to call out some of these people and some of these platforms and say, hey, listen, this isn't right. Sorry, I'm
Very,
being a little
very
more vocal
interesting.
about this. I'm being a little more vocal about this. But I've seen so many entrepreneurs, who have unfortunately failed. They've wasted so many years of their career just because of raising money in these sort of instances.
Interesting caution, but very very interesting counterpoint that you had there. But Sandeep, I would like to pick your mind on, there are there is exuberance in the market, and there are several pools of money available, family offices, corporate funds, and many of them have taken a very, very active interest in early stage investment. A VC, like Mohit said, brings in expertise and research and supervision and making sure that the investor gets his money back, right? In some way, right? And I really like the point that Mohit said, I can't have a good night's sleep if I didn't do that. And then there are also these family offices where it is a pool of money, but they may not have the kind of deep knowledge that a VC would come up with. Therefore, they are happy to do co-investments. Do you think all of this is making a big change, or do you think these co-investments are actually challenging the 220 model? Are you seeing that the corporate funds themselves coming so early on, the strategic acquisitions that would have happened as an exit, having a change? So what are your general thoughts on this?
Yeah, I think, you will see all these pools of capital coexist. It's not a either or. People, one of the interesting things about investing is you may think that this is a great investment and I may think this will be a dud, right? It's a very personal opinion in terms of investment that is made, and that is it depends on the experience that you've had. Mohit made a very interesting point that he didn't do logic nest because he knew too much about that space, right? And so I think from that standpoint, will you see strategic investment pools or exist? Of course they will exist, because there are entrepreneurs that will benefit from having a strategic investor from the get-go. But there are many entrepreneurs that will never take money from a strategic because it limits their market. So that entrepreneur will always seek a financial investor, and in many cases a pooled investor. Now, it increases the burden on the VC, or this is the pooled vehicle. Again, I go back to this point of differentiation, that you have to be able to provide a value add to the capital that you are taking. See, the point is, why does a university endowment in the US give me money? It gives me money because I have a certain perspective on the India market that they will never have. The same applies for a family office that may be sitting in Delhi, and the family may be in the automotive industry. But they will give me money because they have no idea of how to make an investment and how to grow a company in the quick commerce space. That's not what they do, right? So I think the nature of our industry is such that whether it is a wealth manager that is doing a PMS product, or whether it is a wealth manager that is investing in startups, we are fundamentally wealth managers. And the differentiation is the muscle memory and the pattern recognition that you build by being in the space for a long time allows you to add value.
Brilliant point. Brilliant point. Ravi, what's been your experience when you have family offices directly co-investing with you? Or would you like to still have them as your LP in the fund, because you are telling them, hey, there is much more expertise that you bring onto the table as a VC?
Yeah, so two aspects to this. I think one is the family office side. Before I do the family office, I think there is one piece that I wanted to add to what Mohit and Sandeep have talked about, and that is the tenor of the fund, right? One of the pieces I believe a lot of people have not realized is that the maturity or the close-ended nature of any VC investment, and that is something that the angels, at least that I know, Manish and I have been part of Indian Angel Network. We've done a few investments. The angels who are coming in some way had to be almost coached to say that, do you realize that you're taking a 7-10 year bet and it's not a 3-4 year bet, right? And so the perception there is it's almost like a mutual fund, except you don't have the fund manager, you're your own fund manager, right? I think that's the one which is especially true from an angel perspective. That's going away, but it goes back to what Sandeep and Manish talked about in the sense of how are they maturing in that place, right? In some ways, I think the same thing is starting to happen on the family offices, and I'm drawing the same equation, right? I have interacted with both single family offices where, it's almost as the fund manager saying that, look, I'm competing with you, right? When I speak to them, it's almost, you're a VC. Why do I need to give you the 2% carry? I mean, the carry and the 2% maintenance. I can do this myself. I get a deal flow on my own, right? So that sense, I think, is starting to that sense of that realization is starting to dawn up on them, that there's more to it than just identifying, because I'm sure all of the others can tell you, one part is investing into a company, but in India, the big point is that some of these exits have to be engineered, right? The next round has to be engineered. Exits have to be engineered. So in some cases, exits don't happen automatically on its own, as against the US and somewhere else, where you have a great exit process where there is a M&A engine kicking in. In India, you need to kind of steer that through a next round or a secondary or an exit process, right? What some of them still do not realize that cannot happen on its own. It's not a by default kind of a process. And that realization is starting to kick in. So I believe that as more money comes in, more structures will get built out. I think this will just stabilize, but it is still early days, especially when it comes to co-investment. I still think it's early days.
Interesting. I'll slightly switch gears. Consumer facing brands. There is revenue sharing models. I want to go to, let me go to Mohit and then to Manish. Does these kind of models where, there is no pooling of money happening, but there is an enablement for the businesses to take off. And this enablement is more so that, if the brand earns the money is how the investor also earns money in some sense, right? So there isn't that horizon that Ravi alluded to. There isn't that kind of a unsupervised point that Mohit was making. What are your thoughts? Do you, I mean, of course, I believe that these models also will coexist. But the larger point is, does it in some sense VCs will have challenge from here? Do you think, some of these consumer brands don't have to go to the VC at all? What are your thoughts?
I think, Shad, a very interesting set of questions that you asked, right? I'll take on the one part which you spoke about, revenue-based financing. That's not future crystal ball gazing. That's actually taking a step 30 years back. If you go by the genesis of how Uday Kotak started Kotak Mahindra Bank, that's exactly how he did, right? His family was basically one of the largest asset financiers in Mumbai. So revenue-based financing has been there for the longest time. So I don't see that as a future trend. I think that was a past trend, and we don't really need to. I mean, it's going to definitely coexist, right? You will always have a set of founders who say, I love to build my business, but I don't want equity ownership of other people on board. I mean, look at Nitin Kamath, right? Look at the Zerodha brothers, right? They will have all of us lining up for them. If they call up and say, I need capital from VCs, I kid you not, we will all literally stand in a line outside Zerodha's office. But they were very clear that we will build our business without any external capital because we like to have operational control on our business. They use debt as a mechanism, right? So I think revenue backed financing to scale up businesses is always going to be around. Can you say that that's the future? I think very few people have the ability, and you require extreme guts and self-belief to build a business of that sort. I'm not throwing this question on the back of the VCs or the financiers. I'm throwing it back to the entrepreneurs. Do you have it in you to take money in debt and build a business the size of Flipkart? If the answer is yes, go ahead. If the answer is no, then you'll still require us, right? Whether it's angel platforms, whether it's VCs or whether it's PEs, you will still need, we can help you get there at a faster pace. But in case you're somebody like the Kamath brothers, go ahead.
Interesting. Uh, what do you think, Manish?
I think the overall landscape is just far too complex to have a simple answer. Right? There are different assets, there are different natures of businesses getting built, and different financing models will work for them. So today, if as a service organization, which 20 years back was able to raise VC money because that's what it is, but today a service organization will find it very, very difficult to raise VC money, right, as an equity financing. So to my mind, I think these all, and history always comes back, right? The true innovation is far and few in between, right? So revenue-based financing was the model before, it will come back, it is coming back. So different assets will require different models, and I think they will coexist, in my opinion. In certain parts, technology can make it easier. About fractional ownership, as you said, fractional ownership is hard without a blockchain kind of system or some system to kind of make it easier. So technology might make some of these models easier, but I do see them coexisting for different, wherever it suits better. So VCs, I think for at least till I die, the VCs will be there. So it is still some time before VCs become redundant.
All right. And now on the time, we have 6 more minutes. Aditya, if you have questions from the audience, do let us know. But while you are at it, I just want to have a quick question. So, there is the Startup India program. The government is announcing this 10,000 crore. I think it's the same 10,000 crore that they've been announcing the last 2 years. There is the fund goes into SIDBI as a fund of funds, and almost every VC has SIDBI as one of its LP. Do you think at some point in time, Ravi, there should be some kind of a disintermediation that happens and directly these LICs and PF directly invest into VC funds? Or do you still think there should be a fund of funds that come in because of the check sizes that they may be interested in?
So the short answer is yes, there will be disintermediation, not because of somebody wanting to it. I think that's the nature of this whole business, right? So if Manish talked about a blockchain piece, the whole advantage with a blockchain, in fact, I was thinking of that word, right? What it does is allows you to take away all these layers of people that you need to have, all the structures that you need to have, and be able to work through, right? So two aspects, I think what the SIDBI structure did was allowed it to be bootstrapped, right? In the sense it was almost like priming the pump. It allowed the priming of the pump to happen. So once the pump starts kicking in, then you don't really need the pump, the priming anymore, and it can go away. What will probably end up happening is that once you allow for retail participation, so the real issue is two kinds, right? First, there is the concept of an accredited investor. So in India, you need to be able to an angel accredited investor, which means that you have to invest a minimum of 25 lakhs for any of these pooling entities, right? The angel fund, or you have to be able to put together a crore. And the idea is that this follows the same structure in the US, that you have to have a 100K, 200K earnings over a period of time, etc., etc. The idea is to protect, to make sure that the people who are gullible or who can lose money are the ones who are investing, right? Those who can afford to lose money are the ones that are investing. That's, I think, the SEBI thought process for that. But if you go out and say that, look, I have a fund of funds, I have a allocation happening at either a PF or the LIC or even an NPS kind of a structure, then you're talking completely different. These guys are fund managers. So they will treat it as a fund allocation where a certain percentage is set out to a certain asset class, in which case this becomes an asset class that they can fund. And that will open up, according to me, the whole gates in terms of retail participation, interest, all the tracking that you would have. I will not even be surprised that if you will have specified rating agencies who can come in and say, I'm going to look at some structures for that, right? All of that, I think, is in the future, but it has to start with the concept that I need retail participation or do I not need retail participation?
Thanks, Ravi. Do we have questions from the audience, Aditya?
Let me ask them. So audience, you have ask a question button on the screens. Please put up the questions. We have another 5-7 minutes for the session to wind up. So happy, I think we can easily take 1, 3, 4 questions. Shada, we'll just get back.
Sure. While we are at it, I have a question. So there are opportunities, right? Several opportunities in crypto coming up. Okay. Traditionally, what is it that a VC would do? There is money, the sovereign promised money that you exchange for equity, right? Now, what happens in a crypto vehicle? So someone has converted fiat outside, and that would come into the vehicle, the crypto vehicle, and there are cryptos, the tokens that you would take in the company, right? Do you see opportunities? Of course, there are startups that you would want to invest in, which is catering to the crypto world. There is Bitcoin and Ethereum, which will not go away, right? It's $1 trillion plus valuations that we are seeing there. Given a chance, do you think you would do a crypto vehicle itself? Sandeep?
I don't have enough knowledge and I haven't done enough sort of research in this space to comment at this point, but I do believe that you will see crypto vehicles emerge in India.
It's still not legal tender while it is in some countries. So let's see how it pans out. Mohit, what do you think? Would you invest in a crypto company or a crypto vehicle?
I think, Sharda, to be very honest, right, we are in the business of asset management, right? And all of us need to sail where the wind is sailing. As of now, the wind is stagnated because we are in a little bit of a policy logjam where we don't really know the legality around this asset class, right? Just because it's been taxed at 30% doesn't necessarily make it legal. So the moment we have a little more clarity, and I think Polygon's sort of, setting up a great example, right, with Sequoia coming in and a bunch of other investors coming in, particularly with Matic, right? So for a fact that there are a few projects which are definitely going to be here to stay. If you look at the number of use cases that these projects are building out, there are select pockets within crypto which are finding a tremendous amount of scale. And then you have the broader thing, which is Bitcoin, which is still not freely tradable, which is still not exchanged as a medium versus a currency. The day that starts happening, I think that's when we'll see the big shift happening. But I think from our perspective, the moment we have a little bit of a regulatory clearance, we will definitely jump onto it. We are not here to win arguments. We are here to make money, and we'll make money in whatever asset class that it has to be made in.
Manish, do you think crypto is a deep tech and therefore the interest?
Well, crypto may not be, but the infrastructure which powers that falls into that space. So, and luckily for that infra to build, right, it does not transgress the regulatory line. So we are looking at those places. Just as a crypto investment, I think till the regulations are clear, I think it will be too difficult to kind of put something over there formally.
And even investing into those, I think, Ravindra, if at all there is a token, then how do you funge it out into fiat is also a challenge, isn't it?
No. So I think one is I agree with essentially everybody saying that this is something that we should look at. If not, you're just being putting your head in the sand, right? Unless we figure out what it is. But it's always important to I always question why is it needed, and then worry about how do we go about. To me, there are two needs that it fulfills. The first need that it fulfills is that you can fractionalize very easily and not worry about anything else, right? So if you had fractionalization, that would help and support a whole lot of structure into the piece, right? I can go back and take fractional pieces. Now you'll see that has also happened with the small cases, the fractionalized pieces, the stacks in the regular industries, right? The ETFs that are coming in. So I think from a fractionalization perspective, I believe the ETFs will come in very, very quickly, right? That's one half. The second need that it fulfills, and I think this is something that we have to watch out for, is it provides liquidity in a marketplace. I know this is under SEBI, and in the US it's SEC. They have to decide because it is seen as a traded structure. But today, if you ask me what's the biggest issue with a lot of the VC structures in terms of private stock that we hold, is that it is locked in. There's not enough liquidity. Secondary sales are difficult to work through. You have massive discounts onto secondary, even if you want to work through. So if it can provide those two things, right, the liquidity enablement and fractionalization, I see that in the future, it is going to become something that all of us need to keep our eyes and ears open and jump onto it as and when time permits or the legal structure permits it.
Thank you.
Sure.
Aditya,
Yeah.
I'll just do one closing remark.
We have a few questions, Shraddha.
Yeah.
Can we just take, and the panelists from the next panel, sorry for the inconvenience, we'll request you to just hold on for a few more minutes. So one question for all the panelists, anyone can answer is, do you see the venture capital, do you see any major disruptions happening in the venture capital industry itself? And the second part of the questions are there any threats that you can see coming up for the venture capital firms in the way the industry is going right now?
So I think we spoke about disruptions all along, right? All of these are disruptions. If you think about, but there are a few other things, right? The tenor that I talked about has having an open-ended evergreen kind of a fund. I don't know how many people are aware. Sequoia has already taken that route in the US, and just some standard figure for you to understand. And these are out in the internet. You can go check this out. Out of 45 billion that they have in public, in private equity sitting in the public market, 43 is capital gain. 43 billion out of the 45 billion. That means their investment was just 2 billion, right? That end up going into public market. They're working through and saying, I need to evergreen my fund and have longer open PMS model kinds of funds coming in. I think that is one disruption that we'll probably see, which people may question on how do I structure a 220 against that, or do I just keep a 20% on any exit and any entry? If the crypto comes into place, then you are going to have the equivalent of a gas fee. You're going to have a transaction mutual fund kind of a fee, and you will have those participation and that structure coming in a equity structure. So I think just like anything else, technology and disintermediation is going to affect this industry too.
Sure.
Yeah, just to sort of add to that, I think just, for if we have somebody from the regulators listening to this call, right? I think countries are disrupting models for other countries. You look at what Singapore has done with the VCC, it suddenly just completely disrupts the entire Cayman Seychelles structure. So I think from a evergreening perspective, of course, what Ravindra mentioned about a rolling fund, but besides that, just the ability for capital allocators to use umbrella structures and do pools of capital, which is deployed across multiple asset classes, not just VC, in a good tax structure. I think that is really what is the key disruptor for Indian AIF in general, right? I'm not just talking about VC or PE or real estate. I'm saying in general, India needs to wake up and open up their eyes that, okay, our AIF regulations were great when they were made in 2010, but it's 2022 and we have a neighboring country which is literally kicking world ass now. So we need to sort of keep up with that.
Sure. One more question. I think this will have to be the last question to the panel. There are a lot of accelerators and incubators which are now raising money for angel investments or startups, even as low as 2.5 lakh rupees, 3 lakh rupees. What is your view on that? I mean, do you think for a country like India, which the financial literacy is so low, this is a good idea for investors to invest at that kind of price points in startups?
Maybe I'll take that. I had some hands-on experience with this. So I think there is no problem in it as long as you inform the investor what you are getting into. I think that misinformation is a big problem. Like, for example, when we were doing Let's Venture, we got a call from an army jawan. Says, I've saved, retired one, right? I've saved, 10 lakh rupees. I want to make money through startups. I said, please don't invest this anywhere else. Just put it in FD because this is your only saving, right? So the problem is in terms of how these platforms educate investors on the risk profile. Quantum is not an issue because quantum, what happens is that it's a benefit of crowdsourcing. You can actually start with small investments and then build your confidence over a period of time. But information is an issue. Education.
Sure. I think on that note, we will have to wind up this session. Thank you so much, panelists, for taking out time. It was wonderful, wonderful listening to you. Sharda, brilliant moderation, and thank you. You are a big force in putting this up together and getting Sandeep, Manish, Ravindra on board. It was great having you all on the session. I look forward to connect with you all soon in one of our on-ground industry forums. All the best, guys. Thank you so much. Stay safe and have a great year ahead.
Thank you, everyone. Thank you, my
guys.
panelists.
Thank you.
Thank you.
Thank you, Shraddha. Bye.